You wake up feeling incredible. You slept great, the sun is shining, you had an amazing weekend. You feel energized, optimistic, unstoppable. You sit down at your trading desk with genuine excitement about the day ahead. By 10:30 a.m., you've taken 4 trades. Your rules say maximum 2 trades before lunch, but you're feeling so good, so sharp, so in tune with the market. All 4 setups looked perfect to you. By 2 p.m., 3 of those 4 trades have stopped out. You've given back 6% of your account. Your weekly gains are gone. You sit there confused, trying to understand what happened. Here's what happened. You weren't trading the market. You were trading your emotional state. Your positive mood, your energized feelings, your optimistic outlook weren't helping your trading. They were destroying it. This is the paradox nobody talks about in trading psychology. Your worst trading often happens when you feel your best. Your most destructive days frequently occur when you're most emotionally elevated. And until you understand why positive emotions derail your trading just as much as negative emotions, you'll keep experiencing this devastating pattern where great moods lead to terrible results. The psychology of emotional elevation in trading. Here's what's actually happening in your brain when positive emotions sabotage your trading, and why feeling good is just as dangerous as feeling bad. Most trading psychology content focuses on managing negative emotions, fear, greed, frustration, anger. But there's a massive blind spot in this approach. It assumes that emotional neutrality is the problem state and positive emotions are the solution. This is completely wrong. The optimal state for trading isn't positive emotion, it's emotional equilibrium. Your best trading happens when you're neither emotionally elevated nor emotionally depressed. You're calm, focused, neutral. But both positive and negative emotional extremes push you away from this optimal state. When you're emotionally elevated, feeling great, optimistic, and energized, several neurological changes occur that directly impair your trading decision-making. Neurological change 1. Dopamine flooding. Positive emotional states trigger elevated dopamine levels in your brain. Dopamine is associated with reward anticipation, motivation, and risk-taking behavior. When dopamine is elevated, your brain becomes more focused on potential rewards and less focused on potential risks. In your elevated emotional state, your brain literally down-regulates its risk assessment capabilities. You see opportunities everywhere. Every setup looks promising. The potential downsides of trades become psychologically invisible, while the potential upsides become magnified. This is why you take more trades when you're feeling great. Your dopamine-flooded brain is seeing reward possibilities that aren't actually there, while missing risk factors that are clearly present. Neurological change 2. Optimism bias amplification. Humans naturally have optimism bias, the tendency to believe positive outcomes are more likely than they actually are. When you're in an elevated emotional state, this bias intensifies dramatically. Your already optimistic brain becomes hyper-optimistic. You unconsciously overestimate the probability of success on every trade. You underestimate the likelihood of losses. You interpret ambiguous market signals as confirmations of your bullish outlook rather than as neutral or negative information. This amplified optimism bias causes you to take trades with lower actual probability of success while believing they have higher probability of success. You're systematically misjudging risk-reward because your emotional state is distorting your probability assessments. Neurological change 3. Impulse control reduction. Positive emotional states reduce activity in your prefrontal cortex, the brain region responsible for impulse control, planning, and rational decision-making. When you feel great, your brain's executive control systems partially disengage. This feels like flow or being in the zone, but it's actually reduced cognitive control. You're more impulsive, more reactive, less deliberate. In activities where instinct and quick reactions are beneficial, this is good. In trading, where systematic process and impulse control are essential, this is catastrophic. You're taking trades faster, with less analysis, with reduced consideration of your rules. Your elevated mood feels like enhanced capability, but it's actually diminished judgment. Neurological change 4. Overconfidence activation. Positive emotional states activate overconfidence. When you feel good, you feel more capable. Your emotional brain interprets your good mood as evidence of enhanced ability. You unconsciously think, I'm feeling sharp today. I'm on my game. I can trust my instincts more than usual. This overconfidence leads to violations of your risk management rules. You risk more per trade because you're confident it will work. You take setups outside your criteria because you're sure you can read the market today. You abandon your systematic process in favor of intuition that's actually just elevated mood masquerading as insight.
The 4 types of emotional highs that destroy trading. Not all positive emotions affect trading the same way. Different types of emotional elevation create distinct trading psychology problems. Type 1. General life satisfaction high. This is when external life circumstances are going well. Great weekend, good news from family, exciting personal developments. You bring this elevated mood into your trading session. The danger: you unconsciously expect your good life circumstances to translate into good trading results. Your brain creates a narrative that things are going well, which means trading should go well. This expectation bias causes you to misinterpret market signals as confirming your optimistic outlook. Your internal dialogue: everything's going great. This is my time. The universe is aligning. This trading day is going to be amazing. Type 2. Post-win euphoria. This is the emotional elevation that comes after a big winning trade or winning streak. You feel validated, capable, successful. The dopamine from the wins is still flooding your system. The danger: you interpret recent success as evidence of enhanced current ability. You think you're hot or in the zone. You increase risk, take more trades, and lower your standards because you believe your winning streak indicates you're seeing the market with special clarity right now. Your internal dialogue: I've nailed the last 3 trades. I'm reading this market perfectly today. I should capitalize on this. Take bigger positions. Find more opportunities. Type 3. Energy and physical vitality high. This is when you're well-rested, physically energized, perhaps after exercise or caffeine. You feel alert, focused, capable. Your body feels good, and your mind interprets this as readiness for peak performance. The danger: physical energy gets mistaken for trading judgment. You feel capable of processing more information, so you look at more setups, more time frames, more instruments. This increased activity feels productive, but actually leads to overtrading and analysis paralysis. Your internal dialogue: I'm so focused today. I can handle more complexity. Let me analyze more setups. I can trade multiple instruments today. My energy is high enough to manage it. Type 4. Excitement and anticipation high. This is when you're genuinely excited about trading or about specific market conditions. Maybe volatility increased. Maybe your favorite setups are appearing frequently. Maybe there's a major market event you're anticipating. The danger: excitement activates your approach system, making you more likely to take action and less likely to wait patiently. You become trigger-happy, entering trades prematurely because your excited state creates urgency that isn't actually present in the market. Your internal dialogue: this is going to be a great trading day. So many opportunities. I can't wait to get positioned. Let me find entries. The market is perfect for my strategy today.
Meet Yale, the trader whose best days became his worst days. Yale had been trading for 4 years when he noticed something disturbing in his trading journal.
His most painful losses, his biggest drawdowns, his worst trading decisions weren't happening on days when he felt bad. They were happening on days when he felt great. He decided to track this relationship systematically. For 3 months, Yale rated his emotional state each morning before trading on a scale from 1 to 10. 1 was depressed, anxious, low energy. 10 was euphoric, energized, highly optimistic. 5 was neutral, calm, balanced. Then he compared his emotional state ratings to his trading performance that day. The results shocked him. Days rated 8 to 10, emotionally elevated, average loss of 2.3% per day. Days rated 5 to 7, neutral to mildly positive, average gain of 0.8% per day. Days rated 1 to 4, emotionally low, average loss of 1.1% per day. Yale's best trading happened when he felt calm and neutral. His worst trading happened when he felt fantastic, and the losses on high emotion days were actually worse than losses on low emotion days. When Yale analyzed his behavior on high emotion days, he found consistent patterns. On emotionally elevated days, he took 73% more trades than his strategy called for. His average holding time decreased by 41% because he was impatient and excited. His position sizes increased by 29% on average due to overconfidence. His rule violations increased by 84%. Yale's elevated emotional states were systematically destroying his trading discipline. When he felt great, he traded terribly. When he felt neutral, he traded excellently. His emotions weren't helping him connect with the market, they were disconnecting him from his process. Inside Yale's mind, the emotionally elevated trading session. Yale decided to document his internal dialogue during a typical emotionally elevated trading day to understand the exact psychological process. Morning, the elevated starting state. Monday morning, Yale woke up feeling incredible. He'd had a perfect weekend. He was well-rested, energized, optimistic. He sat down to trade at 9 a.m. with genuine excitement. His internal dialogue, "I feel amazing today. I'm sharp, I'm ready. This is going to be a great trading day. I can feel it. Let me pull up my charts. I'm going to find some excellent opportunities today." Yale completed his normal morning market analysis, but his elevated mood was already affecting his perception. Setups that would normally look marginal were looking compelling. His optimistic filter was making everything look more attractive. First trade, lowered standards. By 9:45 a.m., Yale identified a potential trade. According to his rules, it met 2 of his 3 required confirmations. Normally, he would pass and wait for full confirmation. His internal dialogue. Rational Yale. This has 2 confirmations. Your rule requires 3. Wait for the 3rd. Elevated Yale. Come on, this is obvious. Look at the setup. It's clearly going to work. I'm feeling sharp today. I can see this one clearly. 2 confirmations is enough when the setup is this clean. Don't overthink it. Trust your read. Rational Yale. The rule exists for a reason. Wait. Elevated Yale. Rules are for when you're uncertain. I'm not uncertain today. I'm dialed in. This is one of those days where I can trust my judgment. This is the kind of opportunity I don't want to miss. If I wait for perfect confirmation, I'll miss the entry. Take it. Yale entered the trade. It felt great. His elevated state was giving him a sense of certainty that had nothing to do with the actual setup quality. Second trade, reduced patience. The first trade moved sideways for 30 minutes. Normally, Yale would let his trades develop for at least an hour before evaluating them, but his energized state made patience feel impossible. His internal dialogue, "This isn't moving. Maybe it's not the right trade. Let me look for something better. There are so many opportunities today. Why sit in this one when there are probably better setups developing? Let me check other instruments." Yale exited the first trade at a small loss of $40, then immediately found another setup on a different instrument. This one also had only partial confirmation, but his elevated state made it look compelling. This one has better energy. This is the real opportunity. That first trade was just noise. This is the one I should have taken. Get in now before it runs. Yale entered the second trade with barely any analysis, driven by excitement and the need to be in action. Third and fourth trades, the overtrading spiral. By 11 a.m., Yale had taken 4 trades. His rules allowed maximum 2 trades before lunch to prevent overtrading. His internal dialogue about his rule violations. 4 trades isn't overtrading when you're trading well. Overtrading is taking bad trades. These are good trades. I'm just being more active because I'm seeing opportunities clearly today. This is capitalizing on a good day, not overtrading. The rule is meant to prevent bad trading, but I'm trading well, so the rule doesn't apply right now. This rationalization exemplifies how elevated emotional states distort judgment. Yale was violating his rules while convincing himself the rules didn't apply because he was in a special state. Afternoon, the reality check. By 2 p.m., 3 of Yale's 4 trades had stopped out. His 4th was underwater. He'd lost 6.1% of his account in a single session. His entire previous week's gains were erased. Yale's elevated mood collapsed. He felt confused, frustrated, almost betrayed by his own psychology. What happened? I felt so good this morning. I was so certain about these trades. How did this turn into such a disaster? I was seeing opportunities clearly. Or was I? Was that certainty real, or was it just my mood? For the first time, Yale recognized that his elevated emotional state hadn't enhanced his trading ability. It had created an illusion of enhanced ability while actually degrading his judgment, discipline, and process adherence.
The anatomy of emotional elevation destruction. Yale analyzed his pattern and identified exactly how elevated emotions destroyed his trading. Destruction Pattern 1. Perception Distortion. Elevated emotions systematically distorted how Yale perceived setups. His optimistic filter made marginal setups look compelling. His excitement made partially confirmed patterns look fully confirmed. His energized state made him see opportunities that weren't actually there. This wasn't conscious bias. His elevated emotional state was literally changing what he saw when he looked at charts. The market data was the same, but his emotional lens was filtering and distorting that data to match his mood. Destruction Pattern 2. Rule Rationalization. Elevated emotional states made Yale expert at rationalizing rule violations. His energized, confident mood provided endless justifications for why rules didn't apply in this specific case, on this specific day, in his current state. The elevation wasn't making him more disciplined, it was making him more creative at explaining why discipline wasn't necessary right now. His positive mood became a permission structure for abandoning his process. Destruction Pattern 3. Overactivity. Elevated emotions created a powerful drive toward action. Yale's energized state made sitting and waiting feel impossible. He needed to be doing something, taking trades, being active in the market. This translated directly into overtrading, not because he found more valid opportunities, but because his emotional state created urgency to act. He was managing his internal energy state through trading activity, using the market as a stimulation outlet. Destruction Pattern 4. Risk Perception Blindness. When emotionally elevated, Yale's risk perception became systematically impaired. He focused almost exclusively on potential rewards while downplaying or completely ignoring potential risks. His position sizing increased because losses felt unlikely in his optimistic state. His stop losses became suggestions rather than rules because he was confident his trades would work.
His overall risk exposure multiplied because his elevated emotions made risk feel less real. Destruction Pattern 5. Recovery Denial. The cruelest aspect was what happened after elevated emotion trading sessions produced losses. YALE'S emotional state would collapse from elevated to deflated, and he would often try to recover through additional trading. This created a double destruction pattern. Elevated emotions caused initial losses, then the emotional crash caused desperate recovery attempts that amplified those losses. His emotional volatility created trading volatility that systematically destroyed his account.
YALE'S transformation, building emotional equilibrium systems. Everything changed when YALE stopped trying to trade through elevated emotions and started building systems that either blocked trading during emotional extremes or enforced his process regardless of emotional state. System 1. Morning Emotional State Assessment. YALE implemented a mandatory emotional assessment before trading each day. He rated his emotional state from 1 to 10 and wrote a brief description of what he was feeling. If his rating was 8 or above, emotionally elevated, he implemented a high emotion protocol. Maximum 1 trade before 12 p.m., double-check all confirmations with extra scrutiny, mandatory 20-minute waiting period before any entry, position sizes reduced by 25%, no trades on instruments outside his primary watch list. This protocol didn't prevent trading on high emotion days, but it constrained his behavior to prevent the worst destructive patterns. The awareness itself often reduced the elevation simply by making him conscious of his state. System 2. Decision Velocity Governors. YALE built mandatory delays into his trading process that prevented impulsive entries. Before any trade, he had to complete his checklist, then wait 5 minutes, then review the setup again before entering. On normal days, this 5-minute pause felt reasonable. On elevated emotion days, it felt agonizing because his excited state wanted immediate action. But that agony was a signal that his emotional state was compromising his judgment. The 5-minute pause allowed his elevated emotions to settle slightly and gave his rational brain time to reassert control. Many trades that looked perfect in the excitement of the moment looked marginal after 5 minutes of delay. System 3. Hard Trade Quantity Limits. YALE programmed absolute trade limits into his system. Maximum 2 trades before noon, maximum 4 trades for full day. The platform physically prevented him from entering more trades once these limits were hit. This removed his ability to overtrade during emotional elevations. Even if he was energized and seeing opportunities everywhere, the system enforced discipline regardless of his internal state. System 4. Third-party review requirement. For any trade that didn't meet 100% of his confirmation criteria, YALE implemented a requirement to text his trading partner a brief explanation of the setup before entering. Having to articulate and defend the trade to someone else created accountability that counteracted his emotional rationalization. Many times, the act of trying to explain why a marginal setup was actually good enough made YALE realize it wasn't good enough. This external check interrupted his emotional rationalization. System 5. Energy Redirection Activities. YALE recognized that elevated emotional states created excess energy that needed an outlet. Instead of using trading as that outlet, he created alternative energy discharge activities. Before trading, 20-minute high-intensity workout to burn off excess physical energy. During trading breaks, walking, physical movement, anything that discharged restlessness. When feeling impatient, deep work on trading journal analysis or strategy backtesting.
These activities gave his elevated energy somewhere to go that wasn't destructive to his trading. System 6. Calibration affirmations. Yale created specific statements he read before trading on high emotion days. My good mood doesn't make the market more predictable. Feeling great doesn't improve my trading ability. My optimal state is calm and neutral, not elevated and excited. Elevated emotions are a warning signal, not a performance enhancer. These affirmations explicitly countered the unconscious belief that positive emotions equaled positive trading conditions. They helped calibrate his expectations appropriately.
The breakthrough realization. 11 months into his transformation, Yale started a trading day feeling energized and optimistic. His old pattern would have been to dive into trading with excitement, but Yale paused. He did his emotional assessment, rating 8 out of 10, elevated. He had a profound insight. This feeling I have right now, this excitement and energy, feels like it's about the market, but it's not. It's just my internal neurochemistry. The market doesn't care that I feel good. The market is completely neutral to my emotional state. If I trade this feeling, I'm not trading the market. I'm trading my mood, and my mood isn't a market. Yale implemented his high emotion protocol. He took one trade that day with proper confirmation after his mandatory delays. It was a modest winner. His account grew by 0.7%. Driving home that evening, Yale felt genuinely proud, not because he made money, but because he hadn't let his elevated emotions hijack his trading. He had maintained his process despite his internal state wanting to abandon it. Yale's results. The transformation in numbers. The changes in Yale's results after implementing emotional equilibrium systems were remarkable. Before systems, emotionally elevated days, rating 8 to 10, average loss of 2.3% per day. Neutral days, rating 5 to 7, average gain of 0.8% per day. Overall monthly volatility, extremely high with frequent large drawdowns. After systems, emotionally elevated days with protocols, average gain of 0.3% per day. Neutral days with maintained process, average gain of 0.9% per day. Overall monthly volatility dramatically reduced with consistent modest gains. More significantly, Yale's frequency of catastrophic loss days, losing greater than 4% in a session, dropped from occurring approximately twice per month to occurring 0 times over 18 months. Same markets, same basic strategy. The only difference was that Yale stopped letting elevated emotions drive his trading behavior. What to do instead? Your action plan. If you recognize this pattern in your trading, here's your systematic approach. Step 1. Track the relationship. For the next 30 trading days, rate your emotional state each morning before trading, 1 to 10 scale. Track your trading performance that day. Map the relationship between your emotional state and your results. Make this correlation concrete through data. Step 2. Identify your elevation triggers. What situations cause you to feel emotionally elevated? Good sleep? Exercise? Life events? Winning streaks? Document your specific triggers so you can anticipate elevated states before trading. Step 3. Create your high emotion protocol. Write specific trading constraints that activate when you rate your emotional state above 7. Reduced position sizes, trade quantity limits, extended waiting periods, enhanced confirmation requirements. Make these constraints clear and mandatory. Step 4. Implement decision delays. Build mandatory waiting periods into your trading process. 5 minutes between checklist completion and trade entry. This delay acts as a circuit breaker for impulsive decisions driven by elevated emotions. Step 5. Set absolute trade limits. Program hard maximum trade quantities into your platform or trading process. 2 trades before noon, 4 per day maximum. Make these limits physically enforced, not just suggested. Step 6. Build energy discharge alternatives. Create a specific list of activities that discharge excess energy without involving trading. Exercise, journaling, analysis work, learning. Use these when you feel elevated and restless. Step 7. Set random alerts during trading sessions. When they sound, pause and assess your current emotional state. Ask, am I neutral, elevated, or depressed right now? Is my current emotional state affecting my analysis? Build real-time awareness. Step 8. Reframe optimal state. Change your goal from feeling good while trading to feeling neutral while trading. Recognize that calm neutrality, not positive excitement, is your target state. Elevated emotions are a warning signal, not a performance indicator.
The fundamental truth about emotions in trading. Here's what Yale ultimately learned. All emotional extremes impair trading performance. It's not just negative emotions that destroy your results. Positive emotions are equally destructive when they deviate significantly from neutral equilibrium. Your best trading doesn't happen when you feel your best. It happens when you feel neutral, calm, balanced, neither excited nor depressed, neither energized nor depleted, just present, focused, and emotionally stable. The market doesn't care about your emotional state. It doesn't respond to your optimism or your pessimism. It moves based on supply, demand, and participant behavior. When you bring elevated emotions into trading, you're adding a distortion filter that has nothing to do with market reality. Stop trying to trade with positive emotions. Start building systems that help you trade from emotional equilibrium, regardless of how you feel. Your elevated moods aren't market signals. They're internal states that need management, not expression through trading. You don't need to feel great to trade well. You need to feel neutral and execute your process regardless of your internal emotional weather. That's how emotionally elevated trading stops destroying your results. That's how consistent performance becomes possible. Your emotions are valid and real, but they're about you, not about the market. Keep them separate. Trade your process, not your feelings.